It's the most celebrated high-tax, high-welfare economy on Earth. For decades, politicians and activists worldwide have held up the Netherlands as the irrefutable gold standard, proof that sky-high progressive taxes can wipe out inequality and build a fair, equal society for everyone. But here's the brutal, unspoken truth. The top 1% of Dutch households control over 26% of the nation's total wealth. Its wealth inequality is now nearly on par with the United States, the global poster child for runaway wealth gaps. This is the redistribution illusion, the paradox that even the world's most aggressive income tax system cannot fix wealth inequality. Today, we're answering three critical questions. How did the Netherlands build its legendary tax and welfare system to fight inequality? Why has that exact system failed to stop and even accelerated the growing wealth divide? And what does this teach us about the hard reality that we can't reduce wealth inequality with taxes alone? So how did this tiny country, smaller than the US state of West Virginia, with a population of just 17 million less than the state of New York, become the global poster child for tax-based redistribution? If you think this system was born from some socialist utopian dream, you're dead wrong. Its origin story is tied directly to one of the most famous economic parables of all time, Dutch disease. Back in the 1960s, the Netherlands struck black gold, the massive Groningen natural gas field, one of the largest in Europe. Overnight, the country was swimming in easy cash. But as we broke down in our resource curse video, easy money has a devastating dark side. The gas boom inflated the Dutch guilder, gutted its manufacturing sector, and sent unemployment soaring by 400% in just a decade. To fix the crisis, unions, corporations, and the government struck a radical deal, the Polder model. Workers accepted wage freezes to save jobs, corporations agreed to higher social contributions, and the government built a cradle-to-grave welfare state funded by steep progressive taxes. It wasn't about equality at first, it was about saving a collapsing economy. But over time, it became the world's most famous experiment in using taxes to level the playing field. And on paper, that experiment worked miracles. At its peak, the Dutch system delivered income equality most countries can only dream of. Before taxes, the top 10% of earners make 7 times more than the bottom 10%. After taxes and transfers, that gap collapses to just 3 times. For context, that's half the gap in the UK and a third of the gap in the US. Every Dutch citizen gets free universal healthcare, free university tuition, 16 weeks of fully paid maternity leave, and unemployment benefits that pay 75% of your previous salary for up to 2 years. It's an income equality paradise. But here's where the absurdity kicks in. While the government was squeezing every last euro out of workers' paychecks, it left the back door wide open for the ultra-wealthy. Take this real documented example. A middle school teacher in Utrecht making 45,000 euros a year pays a 40% marginal income tax rate. On top of that, she pays a 1.2% annual wealth tax on her 350,000 euro apartment, even though she's still paying off the mortgage. That's an extra 4,200 euros a year on money she doesn't even have in the bank. Meanwhile, a tech billionaire living in a canal-side mansion in Amsterdam with a net worth of 1.2 billion euros pays an effective wealth tax rate of less than 0.04%. That's 48,000 euros a year on a 1.2 billion euro fortune, less than the teacher pays on her salary and apartment combined. Let that sink in. A billionaire pays less in wealth tax than a middle school teacher. That's not a bug in the system, that's the system. The Dutch tax code is designed to tax work, not wealth. The top marginal income tax rate is a crushing 52%, but the top capital gains tax rate, just 31%. Dividends from major corporations, often taxed at 15% or less. family businesses, stock portfolios held in trusts, and commercial real estate, they're either fully exempt from wealth tax or have loopholes big enough to sail a super yacht through. The result? A staggering divide. The bottom 50% of Dutch households own less than 6% of the nation's total wealth. 30% of Dutch families have a negative net worth. Meanwhile, the top 1% have doubled their share of the country's wealth since 1995. We didn't just fail to close the wealth gap, we made it wider. Let's dive a little bit deeper into why this system failed so spectacularly and what it teaches us about the core flaw in using taxes to fix wealth inequality. First, we have to understand the critical difference between income and wealth. Income is the money you earn from your job this year. It's a flow. Wealth is the money your grandparents earned, invested, and passed down to you. It's a stock. Progressive income taxes can flatten the flow of new money coming in each year, but they can't touch the massive stock of wealth that's already been accumulated over generations. That's the redistribution illusion. We're so focused on splitting the annual paycheck evenly, we're ignoring the fact that a tiny group of people already owns the entire bakery. This ties directly to Thomas Piketty's famous D greater than G theory. When the rate of return on capital is higher than the rate of economic growth, wealth accumulates faster than wages can keep up. And in the Netherlands, the tax system actively makes this worse. It taxes wages at nearly twice the rate it taxes capital gains. But the Dutch government didn't just sit by and watch this happen. They tried to fix it 3 times, and every single attempt backfired, making the wealth gap even worse. First, the 2001 Box 3 tax reform. The government promised to crack down on wealthy tax dodgers with a broad wealth tax, but by the time the law passed, it was gutted by lobbyists. The final version only taxed cash, savings, and owner-occupied homes, the assets owned almost entirely by the middle class. Family businesses, private equity, and trusts, fully exempt. Overnight, the middle class got a massive tax hike, while the ultra-wealthy paid nothing. Second, the 2012 inheritance tax overhaul. The government said it would close the loophole that let rich families pass down wealth tax-free. Instead, they expanded the exemption for family businesses to 100%. That means a billionaire can pass down a multi-billion euro company to their kids and pay €0 in inheritance tax. Meanwhile, a working-class family passing down a €200,000 home pays a 20% tax on anything over the €100,000 exemption. Third, the 2021 Global Minimum Corporate Tax. The Netherlands signed on to the 15% global minimum tax, promising to end its reputation as a corporate tax haven. But they kept their infamous innovation box, which taxes profits from intellectual property and R&D at just 9%, well below the global minimum. Today, more than half of the Fortune 500 have their European headquarters in the Netherlands, shifting trillions in profits to avoid taxes. The CEOs and shareholders get richer, while Dutch workers see none of the benefits. From here on, it gets even worse. Today, the Netherlands has the largest gap between income equality and wealth inequality in the entire OECD. Its income Gini coefficient is just 0.26, one of the lowest in the world, a beacon of fairness. But its wealth Gini coefficient is 0.77, nearly identical to the United States, and higher than Germany, France, and even the UK. The numbers are devastating. The median net worth of the bottom 50% of Dutch households is just €12,000. For the top 1%, it's over €2 million. That's a 166 times gap. Worse still, social mobility has collapsed. A child born into a bottom-income family in the Netherlands now takes 6 generations to reach the average national income. That's twice as long as it was 30 years ago. The welfare state that was supposed to give every kid a fair shot has instead locked in a permanent class of haves and have-nots. And the most controversial part, The Netherlands is now one of the world's top tax havens for the ultra-wealthy. 37 of the world's top 500 billionaires hold their family trusts in the Netherlands, more than in Switzerland. The same government that taxes a nurse's overtime at 52% lets billionaires park their fortunes in Dutch trusts, paying almost nothing to the country that's protecting their wealth. The EU has sued the Netherlands 3 times for unfair tax competition, and every time the government has doubled down. This isn't a knock on the Netherlands, it's a lesson for the world. The country didn't fail because it tried to reduce inequality. It failed because it targeted the wrong thing. Taxes on income, no matter how high, can't undo generations of wealth accumulation or outpace the returns of capital. The redistribution illusion thrives because we confuse fairness in earnings with fairness in wealth, and the ultra-wealthy exploit that confusion. The Dutch story proves. Equality requires taxing wealth as fiercely as we tax work, closing loopholes for trusts and family businesses, and stopping the race to the bottom on corporate taxes. Until then, even the most well-intentioned tax and welfare systems will only widen the divide. The question isn't if we can fix wealth inequality, it's if we're willing to target the wealth itself.